In this video, we're going to talk about gap theory and how gap can be applied to crypto. Many people have the misconception that gaps do not apply to crypto because crypto is a 24-hour market that has no close. Unlike the stock market, where gaps are created by the opening day having a higher price than the previous close day, creating a gap in the price, the gaps that are created in crypto are very different and are also very similar to the ones found in the stock market. In the stock market, there are 4 different types of gaps. There's a breakaway gap, exhaustion gap, common gap, and continuation gaps. These gaps are played differently depending on which category they fall in. On crypto, however, there's really only one type of gap that is left behind by the price basically jumping above the current price, and it doesn't necessarily have to close as crypto is a 24-hour market. There are many theories behind why gaps are left inside of the price action. Whichever one you want to believe, whether it's markers left by market makers or a jump of orders that somebody decided to leave on that particular project, is really up to each individual person to interpret. The fact of the matter is that gaps 91% of the times do fill. And there is no time frame or limitation on when they will come back and fill. Please understand that this video is compiled of my personal experience in dealing with gaps for over 1 year. I have studied them intently. I have looked at many projects, whether it be low liquidity, low market cap, all the way up to Bitcoin itself with high market cap and high liquidity. And in all scenarios, the gaps in crypto do work similar across all different types of market caps and liquidity. I'm going to start by covering DGB, which is a chart that I had created a while back in June when we had a run in DGB back in, what day is this here? On June 24th, it started to run basically out of nowhere. There was no news, there was no events coming. It just decided to start taking off. And it had a really nice run. As you can see here, starting on June 24th, all the way to July 9th, it had a very, very good run. Did 100%, a little bit over 100%. During this time, as it started to go, because most of my trading is done based on these gaps, I started to record the gaps that are left behind. Now, primarily, they are 2 different time frames that I look for gaps. One of them is the 1-hour time frame, and the second one is the 4-hour time frame. The gaps in crypto that I use are only applied to the 1-hour time frame and higher. The lower time frames below the 1 hour are not really considered a must fill. And the ones that are above the 1 hour seem to really pull back the price or pull up the price when it's gapped up. And we'll cover that a little bit later. Because of the effectiveness of the 1 hour gap, I generally don't go above the 4-hour time frame too much, since the probability of it coming down on the 1 hour is so high and finding a gap is so time consuming that once I find a gap on the 1 and 4 hour, I generally don't look for higher time frames. Once in a while, when I'm looking through a chart and I'm already in the higher time frames and I happen to catch a gap, I'll mark it, but I don't go out of my way to go look at the higher time frames, since the probability is so high already on the 1 hour time frame. I want to zoom in here and show you what these gaps look like. So I'm going to switch over to the 1 hour time frame. As you can see here, this candle left a gap at the close of the candle, and the open of the preceding candle, it left a space, which is called a gap. On the third candle, it did the exact same thing. It left a gap here between this candle and this candle. As the price continued to rise, it left several gaps. The purple lines, I use those to mark the 1 hour time frames. The white lines, I use to indicate a 4 hour time frame gap. So when we switch over to the 4 hour time frame, you will then see the gap here on this white line that I have marked. But for right now, for the purpose of this video, we're going to cover just the 1 hour time frame, which will be all the purple lines that were left behind on the price action. So as we move higher, you will start to notice, let me move this price action here, more and more gaps that are left behind. Now, sometimes you will have a gap that will show up on the 4 hour time frame and on the 1 hour time frame, just the way it is here. So this here, a white line is telling me that it's found both in the 1 hour time frame and the 4 hour time frame. And I will leave it white since it's found on both of them, and I find it on the 1 hour. This gives me an indication that it's found in both of them. So this way I have a mental note that both the 1 hour and the 4 hour time frame hold the same gap. Here's one that I did not mark and show you clearly what I do. I basically go in here and I click on horizontal ray and I mark my gap. Now what you can do is you can also double click and just type in this text box, gap at 1 hour. And automatically when you hit the enter button, it will leave a text here. Now I'm going to remove this here for the purposes of this video, just to allow you to clearly see where those gaps are. When you have the writing here, it'll tend to block this area here, and I really want to leave it open for you guys to see what it looks like. I'm actually going to remove the text for now, and we can actually move the text over to the center. So let's do that. We can leave it there and we'll leave it on the center so it's out of our way. And as we continue to move on this price action, you will see that these gaps are left behind during the entire run of DGB that it had back starting in June 24th. Now what I'm going to do here is that I'm going to go to a higher time frame to give me more real estate on the screen. We know that these lines represent the 1 hour time frame, so there's no need to stay in the 1 hour time frame since I've already marked them. I tend to go to the higher time frames to give me more basically real estate so that I can see a zoomed out view of what is going on. So during this run, as I mentioned before, it left gaps all the way up here. Now, it took a total of 3 months before all of these gaps were filled, and it bounced almost perfectly on my support line, and it started to go right back up. And that's generally what gaps will do. The gaps that are left behind tend to pull the price action down like magnets. So think of the pressure being pulled from the bottom as the price is continuing to rise. Once it's completed its movement to the top and it starts to retrace, these gaps will start taking on a different role. Eventually, they will get filled. Then it's a 91% probability. But before that happens, something very, very interesting starts to happen with these gaps. One of the things that I've noticed in my studies on gaps with crypto is that these gaps will start acting as support before, the majority of the time, before they get filled. You're going to notice that when a gap is left behind, it will usually, 9 out of 10 times, come down and touch it, but not fill it. Now, what constitutes a fill? Let's look at this gap all the way here on top, before the price action started to come down. We had a gap that was left behind right here. Yet, this price came down here all the way to here, but the actual candle did not close till up here. Now, excuse me, till it closed right here at the bottom of this candle, since it's a red candle. Keep in mind that wicks do not constitute a fill on these gaps. The body of the candle, like this one here, is what constitutes a fill. So when the candle closes here at the bottom below the gap, it is now considered a fill. A fill doesn't necessarily mean that there is no more use for this gap line. So to recap, these wicks do not constitute a fill. The body of the candle needs to come down and fill. So what happens now? Once a gap has been filled, this gap line still serves a purpose. And I'm going to show you what that purpose is. For my research on how gaps work with crypto, I have found that these gap lines will continue to play a role in support and resistance throughout the price action, even after it's been filled. So let's take a look at that. We see the fill happen here, yet, as you can see here, this candle starts playing off the support of this existing, or past, better said, gap line. Then, if we move over to the right, you can see here where the price broke out, came down, it broke the gap line, this is the new support line, it managed to close above it, next candle closed right on it, fell below it, and these preceding candles now are trying to break through it. Here it failed, broke down. We've got the bulls coming in, bringing the price action up, and start looking where this price action starts to find support and resistance right on the previous gap line, which is now going to be considered support and resistance. And look how well it starts to behave and take the role as the new support. Price action rises again, falls exactly on the previous gap line. And look at the way this price action behaves throughout the price, leading about a month after it's been filled. Now, once it has exhausted this new support and resistance, which was our previous gap, it starts to break down. Because as you recall, there are many, many more lines below it acting as a magnet to the price action. And as you can see here, it starts to pull and pull and pull. And look how interesting this is. Remember, our white lines are the 4-hour time frame on the gap, and the purple lines are gaps on the 1-hour time frame. Look how perfect this line now acts as support, resistance, support, resistance, support, resistance, and it continues to play that role until again it finally breaks down and fills it. Well, it filled it here, and then it hits the next gap almost as if it was orchestrated. Look how perfect this is. It's just fascinating. And this is a chart that I'm using as an example, but you can apply the same strategy to any chart that has a gap from the 1-hour time frame and higher. Now look at this here. Let's zoom in closer and see how well these gap lines are now acting as support and resistance. The previous gap that was filled, the 4-hour, now is acting as resistance, and the new gap line is now acting as support until that one breaks down, and it happens to land exactly on the next gap line. As you can see here, is now acting as support. Now the previous gap line is now acting as resistance. And here we go again, support, support, until it finally breaks down and moves over on this candlestick. You can see here where the wick almost touched this next gap line. It broke down, and on this break, the bears really took control here. And as you can see that the price came down, but the bulls were able to recover some of that price action, and it left a wick, leaving this candle right here bouncing between these two 4-hour gap lines. And as you can see where the start and stop of the support and resistance lay is going to be right perfectly aligned with these gap lines. Look at this price action. And this is the reason that I leave these gap lines that were already filled as my new support and resistance, because this is a pattern that I have found to work time and time again. Now, many people, when they look at a gap chart, let me go ahead and just zoom out so we can see some real estate. Before this price action is pulled down to the support line, many people have the misconception of thinking that this price is going to come straight down all the way down to the green line and fill these gaps immediately. And as you can see here, that is not the case. Almost nothing in crypto goes completely down. There's always a stair-step effect that the price action takes. As it's reluctantly going down, it tries to pull up, but obviously the power and the pull of these gaps 91% of the times will win until it reaches a complete fill and a chart completion. Once the last gap has been filled, I now consider this chart to be completed and closed. However, I will continue to leave these lines here in place to continue to act as support and resistance, as I mentioned before. So, when you see a chart, or when you chart yourselves these gaps, it is important to know that many times there is still money to be made between these lines. As you can see here, we had a bounce up here, then we had another breakdown, but we had a bounce. Here, we had a breakdown. It did not quite fill, but we had another bounce. These bounces here are extremely profitable for people who have the skill set of scalping and day trading. They can take advantage of these bounces to their benefit without having to sell off their entire bag because they are waiting for the bottom to come in. It is important to note that whatever comes down will also leave a gap. And you can apply the same strategy in looking in the 1 hour time frames, the 4 hour time frames, or even the higher time frames. Because I have the 6 hour time frame already open, I can already see a gap here in the chart where it's considered a gap up, meaning that the price was coming down and it left a gap on its way down. And one is right here. Now I have been doing this for a very long time, so I can spot the gaps very quickly and very easily. But always remember that you can go ahead and expand the chart and you can see a little bit clearer where those gaps lie. Now, because we're in a 6 hour time frame and this is a gap here, what I'm going to do is I'm going to choose a different color. And I'm actually going to remove the text and edit the text so that I know that it's a 6 hour gap. Now, anything that is a 1 hour gap, I will leave a purple line. Anything above a 1 hour, I will leave a white line with the description. So here we had the 4 hour time frame. Here we have a 6 hour time frame. And these gaps will also work as a magnet for the price action to go up. So as a swing trader, we can find a gap like we do here and look at the current price and know that we have a target here. Now keep in mind that this gap is going to act very similar to the gaps at the bottom, meaning that this price action is not going to go completely in one direction until it fills it. It's going to continue to utilize the existing gap lines, the prior gap lines that are now support and resistance, in the same manner it did coming down. So it's safe to assume that if this is our target, that we're going to hit some resistance along the way before we finally hit this target here. Now we can also move over to the 4 hour time frame and do the same thing with the price action. See if it's left any gaps, maybe a little bit higher. And you continue to do so by clicking on the smaller time frames, expanding your price action, and opening up the candles. There we go, right there. Until you look and find those gaps. And we're going to change this here since this is on the 1 hour time frame. I can actually, here, I'll just put 1 hour here. And we have that marked as our 1 hour time frame. There we go. So now we have several gaps here that have not been filled that will eventually come up and fill the same way it did here. Now, another way of looking at gaps is going to be in two different, let me start over. There are two different ways that a gap can get filled. One of them is going to be when you're looking at the USDT chart and you have the USD value of a coin and the gap is below the existing price action. So you know that when the price comes down, it's going to fill those gaps. However, when you look at a gap on a BTC pair, it can work both ways, unlike the USDT pair. Because the USDT pair is pegged to the dollar value, we know that for something to come down, the value of that coin is going to come down as well. But when you pair it to the BTC pair or the Ethereum pair, that is not always the case. Okay, I'm going to explain how a coin paired to BTC can fill the gap when the price is going down or when the price is going up. So if, for instance, GVT decides to go down because BTC is dropping, it obviously will come down, and if it goes down far enough, it will fall and fill up all these gaps here and probably bounce off the support line, the prior support line that I drew. Now, the current price of GVT in USD value is $11.50, with Bitcoin being at $6,263. However, because of the Satoshi conversion rate, if the current price of Bitcoin was 20,000, then the support that I drew here at 0.00059,431 would cause the price of GVT to be $11.88. So just think about that for a minute. I'm sure we have all seen in a bull run when BTC is going up and you're looking at the alts that are paired to BTC, you will notice them start to bleed. You'll see the red just really coming down and pushing the Satoshi rate down. Many people have the misconception that this is caused by people dumping their alts and moving into BTC, and that is not always the case. As Bitcoin goes higher, it has to account for the new Satoshi rate. So since the current Satoshi rate represents the current price of Bitcoin, as Bitcoin rises, the Satoshi rate is going to lower. And that's why this support here for GVT could mean the price at $11.88, or it can mean close to $5. If Bitcoin is $20,000, this support line here at 0.00059,431 would cause the price of GVT to be $11.88. However, if this was to come down today at the current price of Bitcoin, this same exact support line of 0.00059,431 would put the USD value of GBT at $3.72. So let's recap that for a second. If you guys can break out your calculators on your phones or your external calculators, and you were to type in 0.000180940 times 6263, which is the current price of Bitcoin, it will give you a price of approximately $11.50. Now, if you take that same Satoshi rate and you times it by $20,000, you will notice how different the price is going to be in USD value. The same goes for the support line. So this support line here, if you were to take and times 0.00059431 times 6263 for the current price of Bitcoin, it would give you $3.72. However, this same Satoshi rate of 0.00059431 times $20,000 would put GBT at $11.88. So that is something to think about when you're looking at a chart with a coin that is paired to Bitcoin or Ethereum, that you have to keep in mind that this fill can happen one of two ways. It can happen if Bitcoin dumps, it will cause the alt to dump as well, or if the price of Bitcoin suddenly reverses and skyrockets and goes back up to all-time high, this price action would come down as it's trying to convert to the new higher price of Bitcoin until it will eventually fill. Unlike the USDT pair that's pegged to the $1 US, when that goes down, then it will fill the gaps below the current price action. And if Bitcoin goes up, it has no effect and no bearing at all on the coins that are pegged to the USDT, Tether, or TUSD, or the new Pax stablecoin, because those coins are pegged as a 1-to-1 ratio of exchange to the US dollar, and the USD value of that coin is going to reflect that price. So now you can see how two different pairs of the exact same coin can give you two different results depending on how you pair your coin.